Hello, good morning. I am Olatunji Michael. I'll be taking you through the beginner aspect of Forex training. All I need you to do is take your time and go through this webinar. If there's any way, any level you don't understand, please, you could as well repeat this video over and over again. Alright, so a lot of you have been asking what Forex is. So Forex is basically foreign exchange, and the only thing traded basically in Forex is money. But Forex is divided into a whole lot of things. We have commodities, we have currencies, we have stocks, we have futures, we have energies, we have metals, and we have a whole lot of things traded. But the Forex just stands for foreign exchange, and the exchange is done in a market, so that's why it's a market, just like literally saying the market around you. Okay, so Forex is a market which happens to be the largest financial market in the world. Compared to the New York stock exchange, it has about $5.3 trillion. Alright, it's daily, it's traded, the volume traded daily is about 5.3 trillion. Alright, so compared to other market, it's the biggest. For New York Stock Exchange, we only have about 22.4 billion for a day. Okay, and now the question you want to ask is, what is traded on Forex? Like I said earlier, it's simply money. Okay, so unlike the normal market where you can trade physically, for Forex market, we only have electronical way of trading. It's done electronically, meaning you don't have to go to the physical market. You can just do it right from your laptop or your mobile device. Okay, and the price reflected is the price of a currency is always a reflection of its value. Let's say, for instance, if a currency is stronger than another, we have a price tag for it. And more like if you're going to a mall and you want to know the price of let's say a mobile device, or a price of a car or whatever. Okay, there's always a big price for it. Either it's about 4 million, 2 million, or whatever. Alright, so or probably a wristwatch, a gold wristwatch, a diamond wristwatch. There's always a value. The price reflects the value of an object or a commodity. So in the foreign exchange market too, the price of a currency determines its value. Alright, so once you're buying into a currency, you're predicting that the currency will gain value. Alright, and once you're selling into a currency, you're predicting that the currency will lose value. So it's more like you're looking into the economy of a country, and you're anticipating that probably, let's say for instance, the US economy, if you're anticipating that the US economy is going to grow over time, so you can buy, meaning you're looking forward to the economy growing. Alright, so that means you make money off of your prediction. Okay, if it actually grows. And let's say for instance, if a country gets hit by a natural disaster, let's say a hurricane or something, let's say China for instance, you expect that the currency will depreciate because of the circumstances surrounding it, meaning the economy is going to decrease at some point. Okay, so basically that's what it's about. Forex is about predicting the market direction. If it's going to go up, fine, you predict. If it's going to go down, you also predict. Alright, so either ways you make money, but that's basically if the market moves in a predefined prediction you've made. I mean, so if you're buying, meaning it means you're anticipating that the currency will go up. If you're selling, means you're predicting that the currency value will drop. All right, so either it goes up or down. You can make money both ways, but your analysis or must go within the scope of your prediction. Okay, so currency pairs now, like we said earlier, currencies are traded in the foreign exchange market, and we can differentiate currencies by what symbols they have. Like every currency, every country in the world has its own currency. Let's say for instance, the London, we have GBP, and the first two letter denotes the country, while the third denotes the name of the currency, all right, for that country. So let's say for instance, GBP stands for the GB stands for Great Britain, and while the P stands for pounds. Okay, at Great Britain they spend what pounds as their currency, so the name of the currency is pounds, while the name of the country is Great Britain. Okay, for the USD, of which most of us we are so much familiar with, the US stands for United States, while the D stands for dollar. And Nigeria too, we have the NGN, where the NG stands for Nigeria, while the N stands for Naira. Now a whole lot of countries have their currencies, and it's basically differentiated this through this method, so you can actually find other currencies and try to find a way of relating this idea towards that node. All right, so we'll move to currency pairs basically. So we know in the foreign exchange market all we trade are currency pairs, so we should understand the names of currency pairs and how they are paired. Now no currency moves on its own. Okay, most often in the forex market, currencies are paired. All right, it's like you're pairing two economies together so you can know the value. All right, so once you know the actual value of the currency, you can predict which is stronger than the other. So if one currency is stronger than the other, it will reflect in the direction of which it moves. So we basically have two major categories of currencies here. We have the major currency pairs, and we have the cross currency pairs. Now the major currency pairs are pairs who are paired with the US dollar. Okay, they tend to be the most traded currency in the whole world. You know, the US dollar seems to be like a general currency where most companies, most economy are being used to know the actual value. So for this instance, major currencies are currencies where the currencies that are being paired with the US dollar. If you look by the topmost corner of the right side, you can see that we have currencies like the euro dollar, which is EUR USD. There's a major currency pairs. We have pounds USD, we have USD Japanese yen, we have USD Switzerland, we have USD Canadian, we have Australian USD, we have New Zealand USD. Okay, these are major currency pairs because they are paired with the US dollar and they are traded much often. Now we have the cross currency pairs. And cross currency pairs are pairs that are not paired with the US dollar. All right, there are currency pairs that are not paired with the US dollar. So we're talking about other currencies like Euro pound, talking about Euro Swiss, we're talking about Aussie card, we're talking about New Zealand card, you know, we're talking about pounds card, we're talking about Aussie yen, Swiss yen. All of these currencies are cross currency. All right, they are not paired with the USD directly. Now, advantage of trading forex market. Now, why should you trade forex, the foreign exchange market? And why should you trade the forex market? And one of the few examples points are listed below. Now, 24 hours market. And the foreign exchange market gives you an opportunity to trade the market 24 hours, irrespective of where you are in the country. We all have different continents and we have different time zones. So it gives you access to trading the foreign exchange market in your own time zones. Let's say for instance in Nigeria, you run the GMT +1, which is Lagos, and the Forex market is open for 24 hours, and most brokers open on Sundays at 10 p.m. and they close on by Friday at 10 p.m. same time. And with customer cares are available 24 hours, meaning you can trade from Monday to Friday night, or you can say from Sunday night to Friday night. You can trade the foreign exchange market. It's always open, either you're in Nigeria, either you're Ghana, either you're in Australia, from the States, you're in England. You can trade the foreign exchange market. Excuse me. You can trade the foreign exchange market. Now, no commissions are attached. No government fees, no brokers fees. Most retail brokers are compensated for services through something we call bid and ask price. All right. So there isn't tax, there isn't government fee attached. Whatever it is you make is personal. So it makes it even more interesting, because there's no commission for your earnings you make. Yeah, there's no fixed earnings. There's no limit as to how much you can make it from the market per day. Like we said, it has a volume of about 5.3 trillion dollars in a day. So that means you can actually, out of those volume, you can actually get to trade and make some money for yourself. All right. So out of the overlap of that huge amount of volume that trade every day, you can find a little to make for yourself. So there's no limit as to how much you can make. You can make $1, you can make $1,000, you can make $100, you can make $1 million, you can make hundreds of millions in a day. All right. So there's no fixed amount of earnings. And there's no intermediate. The spot trading eliminates the middleman. It allows you to trade directly from the market. All right. So there's no intermediate. You trade directly from the market by getting good prices. All right. So you get, there's no intermediate between you and the market, unless let's say probably your broker or whatever. All right. So we have low transaction cost, and the cost of transacting is very, very small. It's lesser than even 0.1%. Okay. So the cost of transaction is really, really low. The manipulation, now the most important thing is the forex market is not owned by a single person, not an entity, meaning no person can actually control the market for an extended period of time, not even the central banks. All right. So you can control and manipulate price as you want. It is decentralized. All right. So the forex market is cannot be manipulated as compared to other markets, and that's why it is advantageous. All right. Now, who are the people that participate in the foreign exchange market? Who are the participants in the market? All right. So, Forex was originally intended to be used by banks and large institutions, companies, banks, government organizations, just categorized as large institutions, and not by retail traders like you and I. Now, it's meant for big institutions, but the internet has made things way easier, where we have online brokers we get to integrate us, we gives us access to the market so that we can get to trade using brokers. All right. So the forex participants involves large companies and governments. All right, banks. All right, but it's also and we also can trade, but we are termed as retail traders because we have less capitals to trade. Right. Initially, banks and large institutions to trade, they're allowed to trade the foreign exchange market back in the 90s, because it's capital intensive. You have millions of dollars in your account before you can trade the foreign exchange market. But unlike now, the internet has made things easier. So with a couple of bucks, $100, with $50, you can actually get to trade the foreign exchange market. So that's how low they've actually gotten to bring it. All right. Okay, so forex trading sessions. All right, so all around the world, we will get to understand how you can get to trade the foreign exchange market. Now, every country has a different time zones. Let's say, for instance, in Nigeria has about +1, Ghana is actually +0, and every country in the world has its own different time zones. So we can't be trading the market at the same time. All right. So the market is only open from 8 to 5, like in respective countries. So let's say, for instance, Asian section in respect to Nigerian time zone, which is GMT +1. All right, they trade from 1 a.m. to about 10 a.m. in the morning. So but that 1 a.m. will be their morning over there, which is about 7 to 8 a.m. All right, but using Nigerian time zone, which is about +1 GMT, which will be midnight over here. And London session happens to be related to ours, which is about +1 or +0 thereabout. So meaning in you can trade the London session about 8 a.m. to 5 p.m., which is basically more like our own working time, 8 a.m. to 5 p.m. And the New York session opens by 2 p.m. to about 11 p.m. Okay, and we have other trading zones like the Frankfurt, we have the Tokyo, we have Sydney, whatever. But basically, we want to categorize this into these three markets: the Asian, the London, and the New York. And the best time to trade lies between the New York, the London, and the New York section, because they are the most liquid aspect of the market. During the Asian session, the market is always quiet, because like we said earlier, the most traded currency pairs are the USD pairs, and USD pairs only tend to move during the London and the New York session. You don't expect the USD pairs to move during an Asian session, because during an Asian session we have other currencies pairs that are traded, more like the yen currency, let's say, for instance. Now, so most Asian countries, their currencies are traded within that time frame, but the volume are always lesser compared to the London and the New York. So the best time to trade is when we have high volatility, and that happens when the London and the New York tend to overlap. Alright, so this is the London session and this is the New York session. Now, between this part of this London, within this level, this place around 14 and around 18 thereabout, for about 4 hours, we have more volatility in the market, because we have two markets open simultaneously. So we expected to have more volatility within that time. So, and the better the volatility, the better the chances of making money, because if the market does not move, there's no way you can make money. So you have to trade when the market is actually moving, either to the upward direction or to the downward direction. You have to trade when the market is moving. We know when the market is quiet. And the Asian section is very, very quiet, but the London and the New York session is relatively active. So the best time to trade is between the London and the New York trading session, irrespective of where you are in the country. We're only making reference to Nigerian time zones, which is about GMT +1. Now, Forex Quote. How do we interpret what a currency looks like? So a currency is we have the base currency and we have the quote currency. Okay, so the base currency is a currency by the right hand, okay, and the quote currency is a currency by the left hand. Now, we said having to pair a currency will tell you the actual value of the currency. So for pounds USD, we have about 1.5143. So we're saying one of pounds, a single we're trying to say that a single dollar will give you about 1.5143 pounds, meaning pounds is higher than the USD. So in one pounds you can get 1.5, meaning you can take $1 for 1.5143, meaning pounds is stronger than the dollar, of course. So if it's about 0. whatever, then you're trying to say that the dollar is stronger than whatever the base currency is. Okay, so the currencies are always quoted in pairs, so you get to understand which is a quote base currency and which is the quote currency. Meaning, if you're buying the base currency, it means you're selling the quote currency. All right, so if you're selling the base currency, it means you're buying. If you're selling the base currency, it means you're buying the quote currency, because your action is an opposite of the other. So if you're buying the base, you're selling the quote. If you're selling the base, you're buying the quote. All right. So that's what it's going to mean. That means if you're having pounds USD, the moment you click on the buy button, you're trying to say that the pounds USD will actually move up, meaning the USD will gain strength while the dollar will lose value. All right. But if you are selling, you're trying to say that the pounds currency will drop value while the dollar will actually what move up, or it will gain value. All right. So these are these are what the base and the code currency is. If you look to the right hand side, we have the euro and the dollar. So we have the euro as a base currency, we have the USD as a code currency. So you have to understand that the currency to the left side before the slash is the base currency, and that before the right that at the right hand side after the slash is called the code currency. Now, what is a pip? All right, what is a pip? That's the next question. Now we said you remember we talked about base and code currency. Now and each currency has its own predefined value. All right, so which is a bid and ask price. All right, so let's say the bid and ask price, the bid price for euro is about 1.1524, and the bid price for and the ask price for dollar is about 1.1523. all right, so the difference between them gives you a pip. All right, so if you make the subtraction, then you can see we have 2 pips. If you subtract 1.1527 from 1.1524, it will give you about 2 pips. So meaning the difference between them is about 2 pips. All right, so that will give you a level. It's just like a unit we use to measure the change in currency pairs, the unit change in currency pairs. So if a unit moves from 1.1527 to 1.1528, all right, meaning if it gains value, that is about a 1 pip. Let's assume that it gains value for about 20 pips. That means it has gone relatively into your direction of prediction. All right, so what about spread? Okay, we'll talk about spread. Spread is basically the difference between the bid and ask price. Okay, now in this scenario we realize that the spread is about 2 pips. Okay, so you have to understand what they both mean. Okay, the spread is just the difference between this bid price and ask price. Okay, it could be for this instance is about 2 pips. It could be just how many pips. For different currencies it has a different number of pips. All right, and the more you trade the currency, the tighter the spread will become. All right, so we have the difference between them is a pip, while the spread, this difference between the bid and ask price is a pip, while the difference in currency, all right, the difference, that's the value of fluctuation is measured in pips. Now, what is leverage? Okay, so leverage is a ratio of amount of capital used in transaction. So when you have a leverage, it's more like the literal word leverage itself, what it actually means, meaning the buying power, the capacity to do more in the market. All right, so it varies from different brokers, from 50:1 to 1:1,000, meaning if you can have $10 in your account, and with a high leverage you can be able, your broker can give you an ability to trade as though you're having about $100 to $1,000 in your account, more like they're giving you the ability to buy more. Okay, so you can have $100 in your account, yet you're trading as though you're having 100,000. Okay, they're giving you 1,000 more access to buy into a currency. Okay, and this is very sensitive because the higher leverage you have, then the higher the ability for you to buy and sell. All right, but it's also dangerous because the more leverage you have, the more exposed your account become. All right, so whatever it is you want to transact, it gives you 100 times the ability, the capacity. So if you're winning, it gives you the 100, it gives you about 1,000 ability to multiply what money it is you make. Okay, and if you're losing also, you can lose all your capital within a twinkle of an eye because you have a large leverage. All right, so we have instances where you have a 1 to 100 leverage and 1 to 1 leverage. Okay, so with about 50 pips, move to the upside, you can make $50 with 1:100 leverage, and you can actually make 0.5 dollar, which is about 50 cents. So with 1:1 leverage, you can make about 50 cents. With 1:100 leverage, you can make about $50. Either, let's say for instance you are having about $100 trading balance, all right, and you're having a leverage of 1:100, and the currency moves 50 pips in your direction, then you would have made $50. All right, you'll be so happy you made $50. And but if you're using 1:1 leverage, you would have only made about $0.5, which is about 50 cents. All right, but what about the downside? What if you've actually lost $50 of your $100 trading capital? All right, that means you've lost half of your capital. You feel that the leverage scene is very bad. But if you're trading 1:1 ratio in the leverage, you only have lost $0.5. All right, so the leverage has an advantage and disadvantage. Not until you know what risk or how to understand leverage, then you apply the lesser leverage. All right, so you don't be too greedy. All right, but we're going to take you through all of this, but we want to understand each of the context of trading leverage. So leverage is a good thing, but excessive use of leverage can be a harm. Just like they say, too much of a good thing is usually bad too. All right, margin. Okay, I want to talk about margin. Just like leverage, just a little bit, all right, different. So it's almost the same thing with that of leverage. So if you have a 2% margin, means you can command positions 50 times greater than your funds in your account, just like we said about leverage. Okay, so the margin you have is about 50 to 1, meaning you can command 50 times of your position. Okay, so if the required margin is about 2, you have about $200, and what you want to trade is towards about 10,000. You need a huge amount of leverage, right? But we say, you understand, it's more like you're borrowing money from your broker. So leveraging amplifies price change. All right, so that is, if you're making profit, you make more. If you're losing too, same thing happens, you lose more. So you have to understand the margin you need. You have to understand how to interrelate all of them together, because you can be a very good trader, yet if you don't know how to get to strike a balance between all these components, you're going to have a very, very tough journey as a trader. So that's why you must know how to relate these things together. All right, what is lots? Right, we have lot sizes, meaning it's more like the amount of shares you can buy into a currency. Let's say for instance, the buying capacity, let's say units per share you want to get. All right, so that's lot size. So if you're using a standard lot size, meaning you're getting the real, you're getting the actual value per pip for that currency. If you're using a mini lot size, it's more way smaller. If you're using a micro lot, I mean it's way smaller. All right, so it's more like the number of units you can buy. So that's what lot size is also about. So the higher lot size, the higher amounts you can buy, so the higher profit or loss you incur. Okay, so the lower the lot size, the lower the risk, the lower the profit or loss you can incur. So the lot size, the leverage, the margin, they work almost the same. So you must know how to integrate them. You must know how to understand them. You must know how to use them together. When you're having a high leverage, then you should know you should use a low lot size. If you are using a low leverage, then you can actually increase your lot size a little. But both of them should not work hand in hand. You cannot have a high leverage and still use a high lot size. You will get your account blown. All right, so you must know how to strike a balance, like we said, so that you can have a very smooth trading journey. Now, commission is the fee you're being charged for every transaction being held by the broker. Let's say for instance, when you hold the transaction and you made a profit, you're being charged a commission. All right, it could be just 2%. It's not really that much, but it's just a transaction. There's a commission for however trade you make. So it's not really that much. It's just few percentage of whatever it is you make per trade. Now, account opening. Now, for you to be able to trade, you need a broker. Now, what is a broker, you ask? Now, a broker is a person or a firm who arranges transactions between a buyer and a seller. All right, so you need is someone who brings in the buyer and the seller together to strike a deal. Okay, so off of that deal, they get a commission. Okay, so we have different type of broker. Let's say, for instance, we have insurance, we have real estate broker. Meaning, if you want to inquire, if you want to get a house, acquire a home or a building or whatever it is, a structure, you need a broker. Okay, you get to meet a broker, like a real estate agent. He takes you to however wherever the location is for you to acquire a building. All right, so it meets a buyer, it joins a buyer and a seller together. It doesn't necessarily mean they have the building to themselves, but if you have a home and you want to lease it out, you get to meet a broker to find you a seller, because you may not be able to go out there to be sourcing for people who needs a home yourself. All right, so to make things a bit organized, you need a broker who is going to join, who is going to bring the buyer and the seller together. All right, so we have the insurance broker and we have stock brokers too. All right, so when it comes to the forex, of course we need the forex broker. Now, what will be the deal for forex broker? Okay, whenever you want to trade the forex market, you need a forex broker, because they'll be the one to integrate, to bring the market to you, to between to serve as an intermediate between you and the market. All right, to make the market accessible to you to trade. So whatever profit you make off of that, they get a commission. Meaning, at some point in time, most of the brokers aren't uh, the market themselves. All right, let's say, for instance, the once you want to trade the foreign exchange market, all they need to do is they link you up to the liquidity providers. All right, so the liquidity providers, whenever you place an orders, whenever you place orders, all right, they tend to fill your orders on the other end. Okay, so what the broker does is just join you and the market together, give you access to the market. All right, so we have a couple of examples of forex brokers. We have the super forex, we have forex time, we have hot forex. All right, so all of these we have, etc. We have a whole lot of them, so you can actually get to find out which of the brokers you like based on your trading region. If you're in the states, if you're in England, if you're in Africa, let's say, for instance, in Nigeria, in wherever it is you are, you can actually get to access different brokers as long as you have an internet. So, but when you're about to open an account, just like your local account, there's other things you have to consider. Let's say, why do you like the local bank you use in your region? There must be something you've seen that captivates you. All right. So, when choosing a forex broker account, so there's certain things we want you to always look out for. All right, because not every broker is a good broker, or not every broker is suitable to you based on your location, or other reasons. All right, so we have to talk about security. Okay, so the first and foremost characteristic of a very good broker is high level of security. Now, it's mandatory you know that your funds are in safe hands. You don't want to make deposits into a broker where you can't make withdrawal. Okay, or you don't want to make deposits into a broker where um, you can wake up on a random day and see that they've closed, or they've been shut down, or your money is disappeared, is being hacked, or whatever. Okay, you always want your funds to be intact. All right, because the rule of a business is never to lose your capital, never to lose your business, always to stay in business. Now, if you're going to stay in business, you must not lose your capital, either by blowing your account, or either by your broker mismanaging your money or whatever. So that means your money have to be safe. That's why you need security. Now, cost of transactions. Now, you must you, the cost shouldn't be too much once you're for transacting. Okay, so the profit too much, that the profit you make in a day should not be taken away by transactions. Okay, let's say, for instance, you make about $100. All right, so you shouldn't have cost of transaction which is more than about a percent or 5% of your account. All right, of the profit you make. So let's say, for instance, if you have too much transaction cost, it will almost make you lose the value for the money you've made. All right, so that's why you must find brokers that have low transaction costs, so that you can have a whole lot of profits to yourself. Now, deposit and withdrawal. Now, a very good broker will allow you make deposit and withdrawal, all right, without any stress. Okay, some brokers will let you deposit very easy, but withdrawal will be hell. Okay, we can list a lot of brokers, but they don't need to be shady. All right, so that means you have to do the homework yourself most often. Find a broker that suits you. Find a broker that has, now the thing is, every broker has its own core values. All right, there are some brokers that are good at customer service. There are some brokers that are good at when it comes to deposit and withdrawals. There are brokers that are good when it comes to taking orders, having tight spread. Different brokers have core values, so you have to understand which of the core values you're interested in, or which you think you prefer more. I mean, which is more pressing to you. You might not have a broker that is 100%. I mean, you might not have a broker that is perfect, but at least relatively perfect. Okay, so trading platform, you need a broker that has a trading platform, that possesses its own trading platform, because you have to use a trading platform to trade the market, to make your analysis. Now, a forex market, a forex broker without a trading platform will be shitty. All right, so you need a forex broker with a trading platform. That's one of the criteria. Now, execution, it is mandatory that your broker gets to feel your price. Okay, and every order you make, they should be able to fill that order at some point in time. So you need a very good broker with execution at some point in time. A very good broker with very good execution techniques. Okay, so that you can get the best price out of the market. Not like you're putting in, you want to create a buy or a sell order, and it delays your order and gives you a wrong price. So that means if you want to enter a trade at 1.2042, you should be able to fill you on that exact price you want. Okay, so of course, customer service. A good broker should have a good customer service. They should be receptive. They should have a way of attending to their clients. You know, just like your local bank. All right. So those are the few of the numerous considerations to make, but I think these are the basic ones you should look into once trading the foreign exchange. Once you want to open an account, a forex account. Now we have different market analysis, which are basics we should know. We have about three, but we want to just look at these two basic ones, which is the technical and the fundamental analysis. All right. So technical analysis and analysis made off of reading price action. Okay, once you read price actions, and you're referring to past market data to make future prediction of price movement, you're a technical analyst. All right, because a technical analyst believe in the philosophy that, and they have this psychology also, that history repeats itself, meaning if you can find a pattern to which price relate with in the past, there's high tendency price also move in that similar direction. So history tends to repeat itself. So the data analyst, they make they refer to past data, they get this relatively price patterns, and they try to project it into the future. Now, if price could respect it in the past, that means there's high tendency you can project to the future, price will make similar judgments. All right, so and this happens most of the time to be true, okay, to some reasonable degree. And fundamental analysis, this are analysis made from economic and social and also political point of view, meaning let's say for instance the economy of a country is booming. All right, it's based on the economy, social and political point of view too. So you can actually tend to buy into a currency when they have, let's say for instance, good political point of view, when they have good economy, even social and the whole stuff. All right, and sometimes, most often, you tend to see those things, you make those analysis from the news you get to read. All right, let's say the interest rates, the unemployment rates, the non-farm payroll, all of that type of news helps you to analyze the market. So let's say for instance, if the unemployment rate increases or decreases, it will affect the market in one way or the other. So it's always a negative news if the unemployment rate does increase. So if the unemployment rate increases, then the value of an economy should what depreciate ideally. All right. So but if the unemployment rate decreases, then that means it's actually a positive news, and you anticipate that the economy should keep what growing. Same likewise the interest rate. So you're making analysis based from the news, based off of news being released by by a specific country. So let's say for instance, if a natural disaster happens to a country, like we said earlier before, then you anticipate that there will be the economy will be affected. So if you have a news of a natural disaster in a country, you anticipate that the currency will depreciate. So the analysis you make is off of the news you get. So that's fundamentals. But for technicals, you don't even need any news. All you need to do is look at your price chart and tend to look for price patterns that you can use to project into the future. Now we have Forex Chart. We have different charts in the foreign exchange, in the market, that can be used to represent price. All right. We have the line chart, which is right here. We have the bar chart, which is right here, and we have the candlestick chart, which is right here. All right. So but in the course of this training, we'll basically be using the candlestick chart. At some point in time, we might be using the line chart simultaneously, but most often we basically will be using the candlestick chart. All right. Okay, now forex orders. Okay, so what we have different types of forex orders. Basically we have about three. Okay, but they're also subdivided. Okay, we have the instant execution order. Now this is an order you put in immediately you see price get to a level that you're interested in. Let's say for instance, if you see the price is around the 1.35560, you can just click the buy order or the sell order, right? Then you can just click the sell order or buy order instantaneous. Okay, so the order get filled instantly. So that's an instant execution order. And we have a limit order, we have a stop order. Now these orders are set below or above certain price, for instance. So it helps you track, or it helps you to anticipate price ahead of time. Let's for instance, a limit order is placed let's say for instance, it's a limit order is placed in such a way that you can get the market move in a particular direction ahead of time. Most often, if you're not sitting with your computer and anticipating the price will move into a level, you can set a limit order so that when price gets there, the orders get filled ahead of time. It's more like telling your broker, please, I want to transact within this time frame, within this specific price, but I may not be around when price will get into that. Let's say for instance you have a 9 to 5, so you can set a limit order and go to work. So when price gets to that level, it gets filled. All right, and the trade triggers. So let's say for instance that you're dealing with a limit order, you can have a buy limit order around 1.35440. So what you're trying to say is, once price gets to this level, this is where you want to buy. But even though price is currently here, but when anytime price gets to this level, you want price to drop and buy at this level. That's if you're predicting that the market will keep going up. All right, so let's assume that you're predicting that the market will drop, but the price is relatively below where you intend to enter. Okay, so let's say for instance you want to enter at this level of 1.35560. all right, meaning at this level you can sell a sell limit order, meaning price should come up and fill this order before moving down. Now that means probably you want to see price drop, but you missed an entry, or maybe you want price to come up a little before dropping. Probably you're looking for a very good pricing, you're looking for discounts or whatever. The limit order will be the best to use. But what about the stop order? Now use the stop order, for instance, just like the limit order. Let's say for instance at 1.3544, we are predicting that the market will drop further, will go below this line. You can decide to start buying right from this level. That's how the stop order. All right, so a stop order, you can use it for continuation, meaning if a trade is moving in one direction, you can use a stop order to help you continue in that direction. All right, so it's kind of similar. All right, so there's a little difference, but as time goes up, we're able to explain further when it comes to the practical aspect of trading. So this is just to introduce you to the concept of trading, obviously. All right, now how to open a trading account. All right, now all you need to do is go online, search for forex brokers. Okay, you see tons of forex brokers like this. You have the FX Pro, we have the FXTM, we have the Libertex, we have Hot Forex, Fibo Group, we have Alpari, we have FXTM, XM, we have OptaFX, we have Ingold, we have a whole lot of forex brokers. So all you need to do is log into their website. When you see, after searching for different brokers, you can try them out by logging to their website and find others that have good user interface, you know, that you can actually handle, that you understand, that are swift. All right, so you log into the website, but in the case of this description will be making use of hot forex, and we don't advise you to use hot forex. It's just for explanation purposes. We don't trade with hot forex. We're not partners with hot forex. This is just basically for educational purposes. All right, so let's say for instance this is hot forex and I want to choose hot forex right around here. Okay, all I need to do is search for hot forex and go to their website, which is about hotforex.com. I will get to see a page that looks more like this. All right, so I'll get to log into their website and check the way the site looks like. Then I can click to open an account if I want to. All right, so let's say for instance I want to open an account. So I click on account, I get an interface that looks like this. Okay, which says individual, corporate, or joint account right now. So you can just choose. If you just want to trade for yourself for personal purposes, then you choose individual. If you choose corporate or joint, then that should be a business account. All right, just like your local bank, you can open a personal account, which is individual, or you can open a business account, which is corporate or joint. All right, so it's classified relatively the same. So you put in your country or resident. You basically will fill in the form that comes to you with your date of birth, your phone number, your email address, and what currency it is you want to use as your base currency. Okay, you can use the NGN as a Nigerian currency if you want to. If you're in London, you can use pounds. If you're in the States, obviously you can use the US dollar. All right, so you fill the form given to you by the website, which is basically this form. All right, then you click on the register. Okay, so once you register, an activation code will be sent to the email you provide. All right, which will show your instructions to opening your account, meaning with a link to you getting your registration details and the password and username or whatever. All right, so once you register, you get to click. You have an email sent to your email address, and you can activate your account, more like you verifying your account. Okay, so once you activate, an account will be opened. It'll be made active for you to trade with. All right, so you can decide to open a real account or a demo account, but in the process of identifying what forex broker you want, that means you have to try other brokers and open a demo account. All right, just like it's written here, we have demo account, and this is the virtual account. This is the demo account. It's a virtual account where you don't need to put in your money, your real money, your hard-earned money. All right, so you can just test them out and see how good their spread are, other things that you feel necessary. You can check them out to know. Okay, so we talked about activation. You have to, the final email will be sent to you. You click it. Now, once you've done the activation, you have another email. Okay, that will comprise of username and password, your MetaTrader, and a whole lot of things that you need. Okay, now a MetaTrader account. Now every broker should have a trading platform, which is a MetaTrader. All right, so that is an account. That is a trading software you use to make analysis and also impute your trades. All right, so let's say for instance, still using hot forex as a bias. Okay, so once you open an account, you have a dashboard. Okay, you have a dashboard that looks like this. So you have a deposit withdraw at this other end, where you can make deposits into your account. You can make withdrawals from the profit you make while trading. You have a login details, which is given here, the password also given here, the investor password and the server. And these things should be made only personal. It should only be um, it should just be yours alone, meaning it's private. It shouldn't I have you shouldn't have this access to other people. So when other people have access to this, they can manipulate your account. Okay, they can hurt you. So that's why it's obviously a demo account, but we just want to let you know that this thing should be made private. Okay, just in case it is real account. Okay, this is just demo account, it's nothing big, but we're just trying to make you realize that it's very sensitive. If other people have these details, they could hurt your account, they could log into your account, they could do just whatever to your account. So you always want to make it personal. Then you have to have some way to store them, to save them, either in your mail or whatever. But most often it will be sent to your mail. Okay, these login details will be sent to your mail. But you must realize that it's topmost priority to keep them personal and safe. Okay, so we have different MetaTrader. We have MetaTrader 4 and we have MetaTrader 5. Now both of them are very very good. Nothing really, there isn't really much distinct between both of them, but some brokers trade within both and some brokers trade within just one. All right, so you have to just make a choose and find which you want. Then you use these login details that have been provided here to log into any of your trader accounts, either the MetaTrader or either MetaTrader 4 or 5. So we have other online charting software like TradingView, and we have Ninja Trader. We have a whole lot of trading platforms, but we just want to use MetaTrader because it's the most traded software. Now process over outcome. All right, trading is just 30% physical and 70% psychological. So before you go further, you must understand the risk that the whole thing gets into with. So you must understand the risk when it comes to forex, and you should be honest with yourself 100%. All right, so to be honest with you, it's a skill set that'll take some time to build, which in turn can give you financial freedom, meaning you must understand the risk you want to get into. You don't put any money that you can't afford to lose. You don't get too greedy. All right, because the risk is there. You must, at some point, you can go back to it, forex disclosure, and you can only trade with the money you can afford to lose. Okay, so forex is highly risky. We're not saying you shouldn't trade, but you should understand the risk involved. All right, so our goal is to make it give you a background to trading with low risk and high reward, in such a way you can make money over time trading, but it won't come in a day. You have to understand how to trade. Is a process. It will take a little time, but you must stick with it, and you know keep striving. Okay, skilled traders can lose money. Okay, they can also make money, but what make a skilled trader is more like seeing forex as an occupation or a career. Okay, it doesn't just happen overnight. You can become a professional at trading the foreign exchange market over time because you've studied and you've done your homework. All right, so it's like any other business. You have to be diligent, you have to be patient, you have to work hard so that you can get better. All right, so but but when you're practicing, you don't have to use your real money, your hard-earned money. All right, that means you have to use a demo account to practice. Once you find a method, a trading method, a strategy that fits into your trading style, or how you see the market, how you perceive the market, how you understand the market. So you must learn to trade a demo account first, so that you get to have your trading pattern. All right, before you open your real account. So demo comes first. You must have practiced the demo account for several weeks or months, or however it will take you to go through that lane of mastery. All right, the truth is, experts with experts with several years of experience still encounter periodic losses. Okay, So the foreign exchange market isn't somewhere when you become good at, you don't lose money. No, you lose money even as the topmost or at the best trader in the world. You will lose money, but at some point you get to a point, you get to a level where the difference will be how much you make or lose. Okay, to be successful trading the foreign exchange market, it goes down to what? Risk to reward. All right, you have to know how to manage risk in form of risk management and money management. You should be able to handle both of them, so you can only trade the money you can afford to lose. Okay, so you have to drill this into your head, and there are no shortcuts to forex trading. You have to ensure that you go through our disclaimer over again. All right, so the trading rudiments is just 30% physical. All right, but some psychological aspect of trading, let's say fear, anxiety, stress. We're talking about overconfidence, revenge. All those things are psychological aspect of trading. Okay, so right here we want to make we will try our best to make things easier so that I can have a smooth journey when you're trading. But you must understand that it is process over outcome. You must be able to go through the process. You must be able to take the grind. You must be able to go to the extent. You must be committed. Things like that, so that you get to a point where you can vouch for you, knowing that you can trade. All right, and you can be pleased with yourself, knowing that you've gone through the right channel, you've gone through the right process, and learning how to trade the foreign exchange market. All right, so it's not somewhere you put in $100 and you make $1 million within a month. No, it's somewhere you make a steady income. Irrespective of how much you make, you have to be consistent. All right, so it's a long-term perspective. All right, so it shouldn't something you want to do in a day or in a year and you're out of the game. No, you want to make sure that you can trade if you want for life, but at least you can develop a career. Okay, so you look at it, if it takes you 5 years or 7 years to get through medical school to become an engineer, read basically most professional courses, I think trading should also be given the same type of outlook. All right, so meaning you shouldn't just come into the game within a month thinking you can trade and make $1 million within that same time frame. No, okay, you can make money, but over time. All right, so you have to understand that psychology, that it is process over outcome, not outcome. All right, so you must be able to go through the process. All right, so basically this is what we can give you for the introduction aspect. We have other videos that are going to come up over time, but we want to make sure that you understand our core values as an institute. Our first core value is self-discovery. All right, we help you discover yourself, who you want to be in the foreign exchange market, who you want to be in the financial market, who you want to be when it comes to any financial literature, right? So skill acquisition. All right, so we are also here to give you the necessary skills you need to. Once you've discovered yourself, you need that necessary skill set to give you the lifestyle you've always wanted to do, or whatever lifestyle you want to live. You need a skill set to help you acquire that. Then you also need financial literacy. So the financial literacy, we tend to bring that to you so that you can understand money, how to use money, how to manage money, and how to reproduce money. All right, so that is all we do under financial literacy. So our motto is to empower every African child into becoming an entrepreneur through skill acquisition and self-discovery. All right, so wherever you are in Africa, or doesn't really matter if you're an African, but the most important thing is we always find a way of helping you understand how to relate with the financial market, so that you can get to make your own stipend. You can be able to fund your lifestyle you want. Okay, so all of this is just a beginner concept for you to understand the terms when it comes to forex. We've not really covered so much, but just an introduction, an overview of what forex actually entails. All right, so what this is all about. So we have other videos, so all you need to do is that you get to subscribe to our YouTube channel so that I can get more videos like this. And if you like the video, please always drop a comment so that you can know you find value in it, and to inspire us to do more. All right, so we have a lot in store for you, and we have other videos that will come up. So please, that's a few things we can do right now, but just look ahead and we want to be there with you all through your trading journey. Okay, so we want to carry that burden, all right, to put you through trading the right way, all right. So but you must be able to go through the grind. That's what basic idea is about. Okay, so that will be all for today. Thank you so much for listening. Thank you for being patient. Go over this video over and over again, and if you don't understand anything, or if there's any video you want us to make further, you can drop a comment. All right, so we definitely will go through it and let you know. All right, so once again, I'm Olatunji Michael. Thank you so much for your time. Have a very good day ahead of you. Bye.